Valeant did not collapse because it lacked products. It collapsed because growth was financed, not developed. The company pursued acquisitions instead of research. Revenue expanded through price increases. Debt funded expansion. Earnings were adjusted. Cash flow was projected. Valuation multiplied. The model depended on continuous deal-making. When drug pricing scrutiny intensified, revenue assumptions weakened. When acquisitions slowed, growth decelerated. Debt remained. In 2016, the stock collapsed. Billions in market value evaporated. The failure was not innovation decline. It was financial engineering exposed to regulatory and refinancing pressure. Valeant Pharmaceuticals International emerged as an unconventional pharmaceutical company during the early 2010s. Its leadership rejected the traditional pharmaceutical model, centered on long research cycles. Instead, the company pursued a strategy focused on acquiring existing drugs and businesses. The approach emphasized speed of expansion rather than discovery of new treatments. Management believed pharmaceutical innovation could be replaced with financial efficiency. Research and development spending was reduced relative to industry peers. Capital was redirected toward acquisitions of existing pharmaceutical portfolios. The strategy allowed Valeant to grow rapidly across multiple therapeutic categories. Acquisitions provided immediate revenue rather than uncertain long-term research outcomes. Investors initially responded positively to the rapid expansion. Revenue increased quickly as acquired products were integrated into the company. Each transaction added additional cash flow to the corporate structure. Management presented the model as a disciplined capital allocation strategy. Acquisitions were framed as an alternative to expensive internal research programs. The company argued that many pharmaceutical firms overspent on research. Valeant positioned itself as a consolidator within fragmented pharmaceutical markets. Smaller drug companies became potential acquisition targets. Established medications with stable demand were particularly attractive. The model required continuous identification of acquisition opportunities. Corporate development teams actively searched for purchasable drug portfolios. Investment banks frequently advised the company on transaction opportunities. The acquisition pipeline became a central component of corporate strategy. Boardroom discussions focused heavily on deal flow and financing capacity. Growth forecasts increasingly depended on future acquisitions. Organic research output became less central to long-term projections. Analysts began describing Valeant as a pharmaceutical roll-up structure. The company's identity gradually shifted from pharmaceutical developer to acquisition platform. The strategy relied on continuous capital access and deal availability. Any interruption in acquisition activity could slow revenue expansion. This dependence created structural sensitivity within the corporate model. Structural takeaway: acquisition-driven growth can generate rapid expansion, but embeds dependence on continuous deal flow. Valeant's expansion strategy evolved into a structured roll-up model within the pharmaceutical industry. A roll-up model consolidates multiple companies within a fragmented sector. The strategy seeks to generate growth through acquisition rather than internal development. Valeant targeted pharmaceutical assets that already generated stable cash flow. Many of these assets were older drugs with established demand. These medications required minimal additional research investment. The company could therefore focus capital on purchasing new portfolios. After each acquisition, Valeant integrated operations into its corporate structure. Administrative costs were reduced through centralized management. Marketing and distribution were reorganized under a unified structure. These adjustments were presented as operational efficiencies. Cost reductions improved reported profit margins. Higher margins reinforced investor confidence in the acquisition strategy. The roll-up structure depended on continuous consolidation opportunities. The pharmaceutical industry offered numerous potential acquisition targets. Smaller companies with niche drug portfolios became attractive candidates. Valeant frequently negotiated transactions across multiple geographic markets. International expansion further diversified the acquisition pipeline. Financial markets initially supported the strategy. Debt financing allowed the company to pursue larger transactions. Each acquisition increased Valeant's revenue base. The expanding revenue base supported a higher corporate valuation. Higher valuation improved the company's ability to raise additional capital. This cycle reinforced the roll-up expansion model. Acquisitions drove revenue growth. Revenue growth supported valuation expansion. Valuation expansion enabled further acquisitions. Corporate presentations emphasized the repeatability of the model. Investors were encouraged to view Valeant as a scalable acquisition platform. The company became increasingly associated with deal execution capability. Research laboratories played a reduced role in corporate strategy. Innovation was replaced by acquisition discipline. Financial structuring became central to growth planning. Investment analysts began focusing on Valeant's deal pipeline. Future acquisitions became embedded in revenue projections. The company's growth narrative shifted from science to capital deployment. As the roll-up model expanded, organizational complexity increased. Multiple acquired drug portfolios required integration across markets. Corporate oversight expanded to manage the growing structure. Operational coordination became more demanding. Despite these complexities, the acquisition cycle continued. Growth forecasts remained tied to future deals. The roll-up strategy created scale, but also structural dependence. Structural takeaway: roll-up expansion can generate rapid scale, but ties growth to continuous consolidation opportunities. As acquisitions accelerated, Valeant's capital structure expanded significantly. Financing the acquisition pipeline required substantial borrowing. Debt became a central component of the company's expansion strategy. Corporate leadership viewed leverage as an efficient growth instrument. Borrowed capital allowed the company to pursue larger pharmaceutical acquisitions. Each transaction added new assets, but also increased liabilities. Debt balances accumulated across multiple financing arrangements. Corporate finance teams structured loans to support the acquisition schedule. Credit markets initially provided favorable borrowing conditions. Lenders viewed the company's expanding revenue as evidence of repayment capacity. Bond investors were attracted by the company's growth narrative. Valeant issued large volumes of corporate debt. These funds were directed toward purchasing pharmaceutical assets. Acquisitions continued across dermatology, ophthalmology, and specialty drugs. The corporate balance sheet expanded rapidly. Debt levels climbed into the tens of billions of dollars. Interest obligations increased as leverage grew. Corporate projections assumed continued revenue expansion. Cash flow forecasts supported the debt servicing model. Management argued that acquired drug portfolios would generate stable income. These revenues were expected to support both interest payments and future deals. The acquisition cycle therefore required consistent financial performance. Financial analysts monitored leverage metrics closely. Debt ratios became a growing topic in investor discussions. Corporate presentations continued emphasizing operational efficiency. Executives maintained that integration would sustain strong margins. Financial statements showed rising earnings despite growing leverage. Adjusted earnings metrics reinforced confidence in the expansion model. The market valuation of Valeant continued to increase. Equity investors interpreted leverage as a calculated strategic tool. Debt financing became embedded in the company's growth structure. Each new acquisition required additional borrowing capacity. Capital markets therefore remained critical to the strategy. Access to refinancing supported the ongoing expansion cycle. As long as revenue expanded, leverage appeared manageable. However, high leverage increased the company's sensitivity to disruption. Any slowdown in revenue growth could affect debt servicing capacity. Interest obligations would remain regardless of operational performance.
Debt therefore introduced structural rigidity into the business model. Financial flexibility gradually declined as leverage accumulated. The company became increasingly dependent on stable revenue and capital access. Credit markets continued supporting the expansion for several years. However, the underlying risk profile was gradually increasing. Leverage amplified both growth potential and financial vulnerability. Structural takeaway: debt-financed expansion accelerates growth, but increases structural sensitivity to revenue disruption.
As Valeant expanded its portfolio of pharmaceutical products, pricing became a central driver of revenue growth. Many of the acquired drugs were established treatments with stable demand. These products often faced limited direct competition. This structure created the potential for price adjustments following acquisition. Valeant frequently increased prices on acquired medications. Price increases were implemented after the drugs entered the company's portfolio. These adjustments generated immediate revenue expansion. Higher prices improved profit margins across multiple product lines. The strategy allowed the company to increase revenue without expanding research investment. Corporate leadership framed pricing adjustments as market-based decisions. Executives argued that pricing reflected the value of the medications. Internal financial projections incorporated expected pricing improvements. Revenue forecasts increasingly depended on pricing flexibility. Financial analysts began monitoring the pricing strategy closely. The company's growth narrative continued to emphasize operational efficiency. However, pricing became a more visible component of the business model. Some pharmaceutical products experienced substantial price increases. These changes attracted attention from healthcare providers and insurers. Institutional investors continued supporting the company's expansion. Revenue growth remained strong across several reporting periods. Financial markets rewarded the company's increasing profitability. The company's valuation reflected confidence in sustained pricing power. However, pricing assumptions introduced additional sensitivity to external scrutiny. Healthcare systems began examining pharmaceutical pricing trends more closely. Regulatory bodies started reviewing industry pricing practices. Public discussion around drug affordability increased during this period. Political attention gradually focused on pharmaceutical pricing structures. Valeant's pricing strategy became part of broader industry debates. Analysts began evaluating how regulatory changes could affect revenue. Corporate leadership maintained that the pricing model remained sustainable. However, revenue projections still assumed continued pricing flexibility. If pricing adjustments slowed, revenue growth could weaken. Pricing power therefore became a critical component of financial performance. The company's valuation increasingly reflected these assumptions. Debt servicing models depended partly on sustained revenue expansion. This reinforced the importance of pricing in the overall strategy. External scrutiny gradually increased across the pharmaceutical industry. The company faced a changing regulatory and political environment. Pricing decisions that once appeared routine became more controversial. Financial markets began questioning the durability of pricing-driven growth. The strategy had generated rapid expansion but increased external visibility. Regulatory attention introduced new uncertainty into the revenue model. Structural takeaway: revenue models built on pricing flexibility become vulnerable when regulatory scrutiny intensifies. Valeant's reported financial performance relied heavily on adjusted earnings metrics. Adjusted earnings remove certain costs from traditional accounting results. These adjustments are often used to present operational performance. Valeant frequently highlighted adjusted EBITDA in investor communications. Adjusted EBITDA excluded acquisition-related expenses and restructuring costs. Management argued that these exclusions reflected the underlying profitability of the business. Corporate presentations emphasized adjusted earnings growth. Investors were encouraged to evaluate the company using these metrics.
Adjusted results often appeared stronger than standard accounting measures. Financial analysts began focusing on the company's non-GAAP reporting structure. These adjustments helped sustain confidence in the acquisition model. Higher adjusted earnings supported the company's valuation. Stronger reported performance reinforced the perception of operational efficiency. The model depended on continuous acquisition activity. Each acquisition generated new integration and restructuring costs. Many of these costs were excluded from adjusted performance metrics. The reporting structure therefore separated operational presentation from full accounting expenses. Investors increasingly relied on the adjusted earnings narrative. Institutional investors continued supporting the company's growth story. Corporate earnings calls regularly highlighted adjusted financial results. Financial projections incorporated these adjusted performance indicators. However, analysts began examining the gap between adjusted and reported earnings. Questions emerged about the sustainability of the reporting structure. Large acquisition activity created recurring integration expenses. These costs appeared regularly in financial disclosures. The distinction between temporary and recurring costs became less clear. Financial transparency became a topic of discussion among investors. Some analysts questioned the long-term reliability of the adjusted metrics. The company maintained that adjustments reflected temporary integration costs. Management continued presenting the acquisition strategy as financially disciplined. However, recurring adjustments complicated the interpretation of performance. Debt obligations remained tied to actual cash flow generation. Credit analysts began reviewing the company's financial structure more closely. The reliance on adjusted metrics increased the importance of revenue stability. If revenue growth slowed, adjusted performance could weaken quickly. Financial markets began scrutinizing the earnings presentation. Institutional investors evaluated whether the model required continuous acquisitions. Without acquisitions, integration costs might decline, but revenue growth could slow. The reporting framework therefore depended on sustained expansion. Financial presentation remained closely linked to the acquisition cycle. Adjusted metrics reinforced the growth narrative during expansion. However, they also masked the structural dependence on deal activity. As scrutiny increased, the reporting structure became a focal point of analysis. Structural takeaway. When adjusted earnings dominate financial communication, investors must examine the underlying economic structure of the business.
By the mid-2010s, Valeant's pricing strategy began attracting regulatory attention. Healthcare providers started questioning rapid increases in certain drug prices. Insurance companies reviewed reimbursement structures for required medications. Pharmaceutical pricing had already become a growing policy concern in several countries. Valeant's model brought additional visibility to the issue. Financial analysts began evaluating the company's exposure to regulatory risk. Public discussions around drug affordability expanded. Regulatory agencies started examining pricing practices across the pharmaceutical sector. Valeant's acquisition strategy placed many products under this scrutiny. Several of the company's drugs experienced significant price increases after acquisition. These adjustments triggered broader examination of pharmaceutical pricing behavior. Government officials began requesting explanations from pharmaceutical companies. Industry hearings discussed pricing practices within the sector. Valeant became a visible participant in these discussions. The company defended its pricing decisions during regulatory reviews. Executives maintained that pricing reflected the therapeutic value of the drugs. However, policy attention introduced uncertainty into the company's revenue assumptions. Financial markets began incorporating regulatory risk into valuations. Institutional investors monitored developments in policy debates. Equity analysts evaluated how regulatory changes could affect future revenue. Pricing flexibility had previously supported Valeant's expansion model. If pricing adjustments were restricted, revenue growth could slow. This possibility created new financial sensitivity within the company's structure. Debt obligations remained dependent on stable revenue generation. Credit analysts reviewed the company's financial resilience under regulatory pressure. Corporate leadership emphasized operational efficiency during this period. Investor communications continued highlighting adjusted earnings performance. However, external scrutiny continued increasing. Media coverage expanded discussions about pharmaceutical pricing practices. Public attention intensified across healthcare policy debates. Political leaders raised questions about drug affordability. These discussions affected investor perception of pharmaceutical pricing models. Valeant's strategy became associated with broader industry controversy. Financial analysts revised risk assessments related to pricing assumptions. The company faced an environment of growing regulatory oversight. Revenue projections became more uncertain as scrutiny intensified. Capital markets responded cautiously to policy developments. Equity volatility increased as investors evaluated regulatory outcomes. Management attempted to reassure investors about the company's financial stability. Corporate leadership emphasized diversification across multiple drug portfolios. However, pricing flexibility remained central to revenue performance. Any limitation on pricing adjustments could weaken financial projections. Regulatory attention, therefore, became a material strategic risk. Structural takeaway. Business models dependent on pricing flexibility become vulnerable when regulatory scrutiny intensifies. Regulatory scrutiny increased as Valeant's revenue growth began to slow. Pricing adjustments became more difficult to implement. Healthcare systems started resisting higher pharmaceutical costs. Insurance providers evaluated reimbursement structures more aggressively. These responses affected demand across some acquired products. Revenue expansion became less predictable. Financial analysts revised growth projections for the company. The acquisition engine also began slowing during this period. Fewer large acquisition opportunities were completed. Capital markets became more cautious toward highly leveraged expansion. Investors began questioning the sustainability of the roll-up strategy. Equity research reports examined the company's growth assumptions. Revenue growth remained positive but began decelerating. This change affected market expectations. The company's valuation had previously assumed sustained rapid expansion. Slower growth challenged those assumptions. Institutional investors began reassessing risk exposure. Financial analysts evaluated the durability of the business model. Without continuous acquisitions, revenue growth depended on existing products. Existing products faced increasing pricing limitations. This combination created structural pressure within the company's financial model. Debt obligations continued requiring stable cash flow. Credit markets examined the company's leverage profile more carefully. Corporate leadership emphasized operational stability in investor communications. Management highlighted diversification across multiple drug categories. However, revenue momentum remained weaker than in earlier years. Financial markets responded with increased volatility. Share price fluctuations became more frequent. Analysts began modeling scenarios with slower revenue expansion. These scenarios suggested greater sensitivity to debt obligations. Institutional investors evaluated downside risks. Corporate earnings calls increasingly addressed growth concerns. Executives maintained that the company's assets remained valuable. However, market confidence began weakening. The company's financial structure had been built during rapid expansion. Slower growth exposed structural fragility in the model. Acquisition-driven expansion had amplified both growth and risk. When the expansion cycle slowed, financial pressure increased. Equity investors began reducing exposure. Credit analysts reviewed refinancing risk more closely. Capital market sentiment toward the company deteriorated. The company entered a period of financial uncertainty. Revenue deceleration therefore became a critical turning point. Structural takeaway. When growth slows within a leveraged expansion model,
Financial pressure can accelerate rapidly.
Revenue growth slowed, the company's debt burden became more visible to investors. Valeant had accumulated tens of billions of dollars in borrowing during its expansion. These liabilities required consistent cash flow to service interest obligations. During the expansion phase, revenue growth had supported this structure. However, slower growth changed the financial outlook. Credit analysts began examining the company's leverage profile more closely. Debt ratios appeared elevated compared with many pharmaceutical peers. Financial institutions reviewed the company's refinancing capacity. Bond markets evaluated the company's long-term credit risk. Interest payments represented a growing financial obligation. Corporate cash flow had to support both operations and debt servicing. Any disruption to revenue could affect financial stability. Analysts began modeling scenarios with reduced revenue growth. These projections suggested tighter financial flexibility. The company's financial structure had been designed for expansion. A slower growth environment increased structural pressure. Corporate leadership emphasized cost discipline during this period. Operational efficiency programs were introduced to stabilize margins. Management communicated that the company's assets remained valuable. However, market confidence continued weakening. Equity investors reassessed the company's financial resilience. Credit rating agencies evaluated the sustainability of the capital structure. Some ratings outlooks reflected increasing risk. Bond yields began reflecting greater uncertainty. Institutional investors demanded higher returns for lending capital. Refinancing future obligations became more complex. Debt maturity schedules received greater attention from analysts. Financial projections incorporated rising interest costs. These changes affected investor expectations. Equity markets responded with increased volatility. The company's share price fluctuated significantly during this period. Corporate leadership attempted to reassure markets through investor communications. Executives emphasized long-term value across drug portfolios. However, leverage continued shaping investor perception. High debt limited the company's financial flexibility. Strategic options became constrained by financing obligations. Operational decisions increasingly considered debt service requirements. Financial markets recognized the company's structural leverage. Any further disruption could intensify financial stress. Credit conditions therefore became a key factor in the company's outlook. The company remained operationally active but financially constrained. Debt had amplified growth during expansion. In a slower environment, it amplified risk. Structural takeaway: high leverage can accelerate growth during expansion, but becomes a structural constraint when revenue momentum weakens. By 2015 and 2016, investor sentiment toward Valeant began shifting rapidly. Financial markets started questioning the durability of the company's business model. Revenue expectations became less certain under regulatory scrutiny. Acquisition activity had slowed compared with earlier years. Without new acquisitions, revenue growth became more difficult to sustain. Pricing flexibility also appeared increasingly constrained. These factors altered investor expectations about future performance. Equity analysts began revising valuation models. Market confidence weakened as uncertainty increased. The company's share price began declining sharply. Institutional investors reduced exposure to the stock. Trading volatility increased across financial markets. Research reports questioned the sustainability of the acquisition model. The roll-up strategy had produced rapid expansion. However, it also created structural reliance on continued deal flow. When acquisitions slowed, growth projections weakened. Financial markets reassessed the company's valuation assumptions. The company's market capitalization began falling quickly. Billions of dollars in equity value were erased within months. Equity markets reacted strongly to the changing outlook. Institutional investors sought to limit downside exposure. Credit analysts simultaneously examined the company's leverage position.
Debt obligations remained substantial despite declining market value. Financial markets recognized the company's structural vulnerabilities. Investor confidence continued deteriorating during the period. Corporate leadership attempted to stabilize market perception. Executives emphasized the long-term value of the company's drug portfolio. Management argued that the underlying assets remained profitable. However, market sentiment had shifted significantly. Investors now viewed the company through a risk-focused lens. Share price declines accelerated across multiple trading sessions. Financial news coverage increased attention on the company's situation. Analysts debated whether the business model could stabilize. Equity markets continued repricing the company's risk profile. Institutional investors reduced holdings further. Market volatility reflected growing uncertainty about future performance. Debt remained a central factor shaping investor expectations. The collapse in market valuation occurred rapidly. The company had once been among the most valuable pharmaceutical firms. Within a short period, its valuation contracted dramatically. Financial markets had reassessed the structural risks embedded in the strategy. The collapse illustrated how quickly sentiment can reverse. Growth expectations had previously supported high valuations. When those expectations weakened, market value declined sharply. Structural takeaway. When market confidence in a leveraged growth model breaks, valuation can collapse rapidly. After the sharp decline in valuation, Valeant's leadership began focusing on stabilization. Corporate strategy shifted from rapid expansion to financial restructuring. The company reduced emphasis on large acquisitions. Management prioritized strengthening the balance sheet. Operational discipline became a central theme in investor communications. Cost control programs were introduced across multiple divisions. The company reviewed its portfolio of pharmaceutical assets. Some non-core businesses were considered for divestiture. Asset sales became one method of reducing financial pressure. Corporate finance teams examined options for improving liquidity. Debt obligations remained significant. Refinancing strategies were evaluated to extend maturity timelines. Credit markets remained cautious toward the company. Executives worked to restore credibility with investors. Investor presentations emphasized operational stability. Management highlighted the value of established drug portfolios. However, restoring confidence required time. Financial markets continued monitoring the company's leverage. Debt levels remained a central focus of analyst discussion. Operational improvements alone could not immediately reduce liabilities. Corporate restructuring, therefore, became a long-term process. Leadership changes also occurred during this period. New management sought to reshape the company's strategic direction. The company began repositioning itself as a more traditional pharmaceutical business. Research investment was gradually reconsidered. Operational priorities shifted toward sustainable growth. Financial transparency became increasingly important in investor communications. Corporate disclosures expanded during restructuring efforts. Institutional investors evaluated whether stabilization efforts would succeed. Credit analysts monitored progress in debt management. Equity markets remained cautious toward the company's recovery prospects. The company continued generating revenue from existing drug portfolios. However, growth expectations were significantly lower than before. Expansion was no longer driven by large acquisitions. Financial markets viewed the company through a restructuring framework. Corporate leadership focused on gradual stabilization. The restructuring process required time and discipline. Debt reduction remained a long-term objective. Operational performance had to support financial repair. Market perception slowly adjusted to the new strategic direction.
The company remained active but under increased financial constraint. Stabilization replaced expansion as the central corporate objective. The restructuring period illustrated the long recovery from a leveraged expansion model. Structural takeaway. When leveraged expansion reverses, corporate recovery typically requires long-term restructuring and financial discipline. The collapse of Valeant Pharmaceuticals provides a structural case study in acquisition-driven growth. During its expansion phase, the company demonstrated how financial engineering can accelerate scale. Acquisitions allowed rapid revenue growth without long research cycles. Debt financing amplified the speed of expansion. Equity markets initially rewarded the model. Investors viewed the strategy as a new pharmaceutical growth framework. However, the model relied on several critical assumptions. Acquisition opportunities needed to remain available. Pricing flexibility needed to remain intact. Capital markets needed to provide continued financing. These conditions supported the company's expansion for several years. When those conditions weakened, structural vulnerabilities became visible. Regulatory scrutiny challenged the pricing assumptions. Slowing acquisitions reduced growth momentum. Debt obligations remained fixed regardless of expansion pace. Financial markets reassessed the company's risk profile. Equity valuations adjusted rapidly. The company's market capitalization declined dramatically. The reversal demonstrated how quickly investor confidence can change. Growth expectations had supported the company's valuation. When those expectations weakened, valuation declined sharply. Debt amplified both expansion and vulnerability. Leverage accelerated the company's growth during favorable conditions. However, leverage also reduced financial flexibility during stress. Corporate strategy became constrained by existing liabilities. Operational stability replaced aggressive expansion. The company entered a prolonged restructuring phase. Leadership shifted toward balance sheet repair. Financial discipline became more important than rapid growth. The case illustrates the structural dynamics of leveraged expansion. Acquisition-driven growth can produce impressive short-term results. However, the strategy embeds dependence on external conditions. Regulatory policy can affect pricing assumptions. Capital markets influence refinancing capacity. Market sentiment can alter valuation quickly. When several pressures emerge simultaneously, structural stress increases. Corporate collapse often reflects structure meeting external stress. Valeant's experience illustrates this interaction clearly. The company did not collapse because pharmaceutical demand disappeared. The collapse reflected the interaction between leverage, pricing, and market confidence. The business remained operational, but its valuation and strategy were fundamentally altered. Corporate recovery required long-term restructuring rather than rapid expansion. The case remains a reference point in discussions of acquisition-driven business models. Structural takeaway: acquisition-driven growth magnifies risk when refinancing and pricing assumptions weaken, demonstrating how corporate collapse often reflects structure meeting external stress.